What's up, everyone? It's Caddy with MoneyVest. So everyone's favorite stock, SOFI, is dropping like a rock, down a little bit over 10% on the back of a downgrade, and that's exactly what we are going to discuss in this video. It's going to be a complete update for you on this company. We're going to take a look at the stock and, of course, technical analysis, fundamentals, all that stuff. As always, make sure that you drop a like and really appreciate you subscribing to the channel if you haven't already. And do check out the links down below for our Discord, for our Patreon. There is a 16% annual discount that's available until a couple more days because I did extend that sale for New Year's, and you can access all the members only private videos, Excel spreadsheets that are also available with my fair values, with my intrinsic values for a lot of these companies, and the Discord channels with over 20 plus channels available. You can engage and interact with thousands of traders and investors worldwide, and of course have access to all the options alerts, trade ideas. Everything's going to be included with the link down below. Would love to have you on board. So, and also do connect with me on Instagram. My handle is going to be CastWRP. Completely forgot about that. So, SoFi stock tumbles on downgrade. Lower rates might not be a good thing, according to this analysis from Keefe, Bruyette, and Woods analysts. So, KBW, led by Mike Perito, downgraded SoFi to underperform from market perform, lowered revenue and adjusted earnings estimates, and trimmed the price target to 650 from 750 in a report on Tuesday as well. And this right here is the shares absolutely dropping hard at over 10%, down to $8.60. We'll go over the entire technical analysis for the company as well. It's kind of interesting how it got up to that resistance of $10. It got very overbought, and today is the first day where we are starting to see that MACD line crossing below the signal line, which of course is a little bit of a sell signal from a technical analysis perspective as well. So the main sort of thesis is that SoFi began as a lender focused on refinancing student debt, and it now operates through three segments: lending, which includes student, personal, and home loans; financial services; and technology platform as well. And there are a few factors prompting the rating slash. First, SoFi shares have been gained over 43% since reporting the third quarter earnings, compared to a 30% jump from the KBW nasdaq Financial Technology Index recorded over the same period of time. That is a very BS sort of analysis, because just because a stock is outperforming the index does not mean anything. Like, just because it's up over 43% doesn't mean that it warrants a pullback. That is crazy. Second, analysts revised their revenue and adjusted earnings estimate for SoFi to below consensus. Now, this has more weight, and I think this is a much bigger reasons why we're seeing a little bit of a downgrade on SoFi. And they mentioned, and I quote, "SoFi shares remain polarizing, but noise aside, anytime a growth stock is trading at a premium valuation with a 15 to 20% downside potential to consensus EBITDA, we believe a more cautious stance is appropriate." So basically what they're saying is that the valuation is a little bit more expensive for the stock. If you come over to the valuation multiples for SoFi, you'll notice that it's trading at over 23 times cash flow, and enterprise value to EBITDA of almost 18 is what it shows right now, and a little bit over 3.5 times sales at the moment. No price to earnings, because the company lacks earnings and profitability at the moment, which is one of the reasons why I'm lacking conviction and confidence in this company just yet. But of course, long term, if they execute well, that is going to come back. SoFi shares have rallied along with other equities on the notion that the Federal Reserve may begin cutting rates this year. But looking at the larger picture, this could actually weigh on earnings thanks to the company's fair value accounting, is what they also mentioned. So what they're basically talking about is that SoFi sells off the loans. So basically, when they finance all these loans, they collect cash flow, right? And they sell off all these loans that it generates to other companies at a marked up value, given how high the rates are. So if, let's say, rates are higher and lenders are refinancing all the loans for the borrowers at a higher rate, that means that is going to be higher cash flow for the lenders, right? Because all the loans that they sell are assets for the lender, and higher interest rates means higher income for these businesses, for these lenders, SoFi included. So they are essentially marking up all the value of these loans on the books to include for the expected future resale price according to the higher interest rates. But if interest rates start coming down, if cost of borrowing starts going down, and a lot of the borrowers now refinance at a lower rate, that does what? That lowers the value of these loans, right? The market value of these loans gets lowered, and as a result, the resale value of these loans will also be lower. And they mentioned that every quarter point reduction to SoFi's fair value mark for its held for sale loan portfolio equates directly to $50 million drag on revenue, or 5 cents of earnings per share. So every 25 basis point drop in the fair value mark for its held for sale loan portfolio will lead to $50 million in revenue and 5 cents per share in earnings drop. A few pennies might not sound like a lot, or it can move the dial, but in the case, every cent matters. For its fourth quarter, management is aiming to report its first profit according to generally accepted GAAP and accounting principles. Now, one thing that they have not accounted for here is what? Lower interest rates leads to more volume. So what might be a drag of 50 million or 5 cents on earnings per share because of the lower resale value may be offset or compensated by a higher volume lift because of lower interest rates. Because if interest rates are lower, that's going to lead to more volume of loans and more financing in general, as opposed to, of course, the resale value of these loans coming down. So I think that is something that needs to be accounted for because it's a give and take, right? Yes, we know that higher interest rates leads to less financing, but it's more expensive, more premium financing. And when rates are lower, yes, the resale value and the financing income is going to be lower. The net interest margin is going to be lower for a lot of the lenders, but they're going to make up for all that lower margins in volumes that they do, right? They do higher volumes when rates are lower. So I think that's something to keep in mind. And I think this may be a little bit of an overblown reaction from the market, down over 10.6% on the back of this downgrade. But as I mentioned before, SoFi has got a lot of potential. It's a phenomenal business and a great company, but it still lacks execution to profitability, because that is one of the most important things that I look for when I'm investing in a company long term is execution and profitability. So 2023, of course, negative earnings. 2024, the forecast is for them to finally turn the corner towards profitability on a GAAP basis, 8 cents per share. We'll find out soon enough if this year is going to be the year for SoFi for when they actually turn the corner towards profitability. But technically speaking, of course, we were overbought. Of course, we were coming up to that resistance of $10. And if it does end up down at $7.91, close to $8 per share, so this right here is going to be a very, very important support level to watch for SoFi. I do believe that it's going to stabilize at those prices a little bit, at around $8. And I wouldn't mind sort of adding a little bit more to my position on SoFi. And of course, at $6.50, so if it ends up breaking down below the support, so if it ends up breaking down below the support and kind of ends up even further down, then this right here is going to be that next most important support at $6.50, kind of in line with this previous resistance, and of course a support level over here as well. And that is going to be that next target to watch for SoFi. So let me know your thoughts down in the comment section below. In a nutshell, long story short, I do believe that this is a bit more overblown because yes, rates are coming down. Lenders are going to struggle a little bit, but they're going to make up for those net interest margin compression in the higher volumes of loans they're going to do. So that's going to offset the resale value, which is going to drop on the back of lower interest rates. But at the end of the day, fundamentals are strong, but the company still needs execution and a path to profitability, in my opinion. So that is something to keep in mind. Support level is going to stay put right here inside this sort of green sort of rectangle. All the way down to 650s is another level that I'm watching very closely for the company, where I'll be interested in buying more shares for SoFi. So let me know your thoughts down in the comment section below. I know it's one of the best stocks for many people. They're lovers of SoFi, so let us know down in the comment section below. As always, if you enjoyed this video, found it helpful, make sure that you drop a like. Don't forget to subscribe to the channel. Again, links to our Discord and Patreon is going to be down below if you're interested in joining. And again, getting access to our Instagram, link's going to be down below. Connect with me there. And as always, happy investing. I'll see you all in the next video.